So on the course website, you already have the homeworks and the syllabus. There's videos up there if you need to review the videos. If you need to do any makeup on the in-class. The midterm exams already posted. We've got till the 27th, so you've got plenty of time. And you've already put together one deliverable package, so the next one should be theoretically easier. I would like to see the memos at some point today on the way out. Again, start bringing me memos. Okay, get those memos going, get the format down, start replicating the memos, and start coming to see me so I can go over them. I really like working with students on their memos because we work really close together. I can teach you, how to write really powerful memos and briefs. I can teach you how financial economists and analysts, how they write, because I've been doing it for 25 years. And you really need to sit down with somebody who's really good to be able to teach you, how to do the writing, because the communication classes that you take in the English classes are not business level writing, and they're going to probably expect you to do some writing at some point in time, and you want to be able to show that you can perform, you can write at a very high level walking in, because they'll probably ask you to do some editing and to do some copywriting, and maybe even update the website. So give me the deliverable one. You have up until next Thursday. Just bring it to me all next Thursday, and I'll just make it easier for me to grade. The makeup work is due Thursday, March 30th, so everything's due Thursday, March 30th. Also, memos 1 through 3, which you should be doing, is handing in all 3 memos. Every time a memo is due, you hand in all the other ones. So I'm constantly editing, correcting, editing, so that as you progress through the semester, the quality of the memos get higher and higher, and then you can start using them as writing samples. Okay? But I want to make sure by the end of the semester that all 5 of the memos are totally perfect. Okay?
So we turn in the memo that we turned in with our first deliverable and then 2 new ones?
Yeah. So by now your formatting should be in place. I should have already edited one of your memos. You should have come to me already. So the quality of the memos should be level 2, level 3. So you can start replicating the analysis and start replicating the memos and start getting me basically some content, so that I can go through not just 1, but now I'm going through 3 and 4 and 5 at a time. Okay? And it should get easier and easier every time I go through it. And at some point I'm going to go, these are done. Okay? Now go to production. Now go print out the color copies. I've already signed off on them and put those in the deliverable for the end of the class. Okay? So it's more of an iterative process. For the resubmission, make sure you correct and resubmit the in-class exam. We had a review session, which was like about an hour and a half. So we walked through everything, all through the details. So if you're stuck on any section or highlighted any sections where I'm asking you to put more detail, I would probably go back to the exam review video and just walk through and put in as much detail as possible. Okay, so I really want you to memorize the details. Take-home exam, I've already posted the solutions to that in the homework, so I want you to go back, review, see where your mistakes were, check off that you checked them, and then you should be in really good shape. And you've done a lot of practice on those, so they should get easier and just make more sense. Again, the memos, when the second one's due, give me the first and the second. When the third one's due, give me the first, second, and third. Give me all of them in batches. So I'm constantly reviewing and updating those. Homework 2 is due on April 13th. So a little less than a month from now. Again, I think I've given you plenty of time. If you get stuck on any of the take-home or any of the homeworks, come see me. We'll sit down through the solutions manual. We'll work through the problem so you don't get stuck. Do not get stuck. Okay? If you get stuck on a problem, do not frustrate over it and feel like you have to solve it, and you're going to solve it. You're going to run out of time, and you'll be frustrated. So the key to test taking is you solve the problems you can solve. You skip the ones that you can't solve, you go back and try those again, and if you have any of them you just can't answer, you just either skip them, and in this case you're going to work with me and we'll solve them together. Okay? And then next Tuesday, what I would like to do is do an ethics and finance session, talk about some of the ethical dilemmas that I've had to confront in my finance career and how I approached them and the decisions that I made. Maybe the decisions you'll make will be different than the decisions I made, but I think it's an interesting case study and an application that you'll probably have to confront at some point in your career. You'll probably have to make moral and ethical decisions, and we'll see how you approach it. So I'll present some of my work and the decisions that I've made, and we're going to watch the Inside Job. I don't know, is anybody familiar with the documentary by Charles Ferguson? He does a really good job of, it's an award-winning documentary. He does a really good job of documenting the corruption, and the just criminality, involved by pretty much all participants, leading up to the financial crisis, and then the financial crisis. And then I've specialized on the financial crisis over the last 9 years, so I have a really good view of how it happened and the total costs. And it's not pretty. It's going to cost us between 10 and 30 trillion dollars over your lifetime. So we hope that these kind of things never happen again, and they probably will, unfortunately. And you'll probably need to be watching out for what these guys are doing, because they'll take us down again. And then today what I'll do is I'll quickly go through chapter 11, which is on capital flows and capital budgeting. And I'll also provide you with some spreadsheets. You should have already gone up and downloaded the Excel spreadsheets from the first 10 chapters. I highly recommend that you download, when I make them available, the Excel spreadsheets, and then save them in an archive, because you may need to use them at some point in time in the future, and it's easier to use templates that have already been programmed than have to program your own templates. Okay, and I'll go through some of them too a little bit later on. And then what I want to do too is really start moving into application. The application that I've designed over the last 5 years, and actually I started working on it about 10 years ago, was what I call financial integration, which is really an integration of financial theories in an application to be able to make investment decision making. So how do you make an investment? How do you make a decision to buy a high-tech company? How do you make a decision to buy a portfolio, multi-billion-dollar portfolio of real estate? How do you make a decision to invest in a stock? The discounted cash flow models are basically all the same, but the nuances are slightly different depending on the type of asset that you're going to acquire. And the book has some examples of applications, but the book was published in 2014. Things have changed a lot since then, and based on my experience in private equity and real estate acquisitions and development and securities analysis, I think it's probably more important to teach you the application of the theory that you're learning from the book in a real life situation, because you're going to go work for industry, and this is how they're thinking about, and a lot of these companies do buy other companies, and they do make investment decisions based off the capital budgeting theory that you're learning in the class. First, I want to quickly, before we get into it, and then I'm going to move pretty quickly, is can you give me the market updates, because a lot's going on with what happened in London yesterday. There's been some movements in currencies. There's been some movements in gold and oil, and definitely some movement in the stock market. So if you can give me an update on the Dow, is it up or down for the week? Why, if you can give me a couple reasons why, that would be really important. Is anybody tracking the markets?
The Dow's up.
Today?
Yeah.
Yeah. What's it? Is it down for the week? Last week, I think it was down for the week, the first time since October.
Yeah, it was, and it's just starting to go up again today. So yeah, it's down for the week.
Okay. Any impetus other than the sell-off? Because usually the market's been going up since basically late last year, and after the presidential election, it's just been going straight up. It's just been going up. And at some point in time, it gets too high. And there has to be a blow off, there has to be a correction in the market. So do you know what it's down for the week?
It's down 0.92% for the week.
Okay, so it'll be interesting to see what happens next week. And other announcements, has there been any corporate announcements by major companies that make up the S&P 500? Is there any news, on Fed policy or interest rates? Anything else other than the terrorist attack that occurred yesterday that might have moved the markets? No? Okay, so where's oil right now? Start thinking about, maybe before you come in class, start doing a little research and coming in with the movements, but also the whys. See if you can answer why the markets are moving.
Oil prices down.
And where are oil prices per barrel right now?
$48.
$48. And then, weren't they below that? Weren't they at 47?
Yeah, they're down. They're down for the weekend.
So they're a little up.
They're
And
a
when was the
little
last time they were around 55? That seems to be like the resistance on the oil prices.
March 7th.
Okay, so not too long ago it hit 55 and
Couple
now it's at
weeks ago.
48. So that's a pretty big move. Any views on why oil prices have fallen over the last 2-3 weeks?
More U.S. drilling.
Yeah, more U.S. drilling. Any others? More production.
More in the Middle East.
More production in the Middle East, although they're trying, aren't they, to cut back?
Yeah,
Isn't
but
OPEC under?
it's just they have a lot of inventory in the Middle East, I think,
Okay.
right now.
So you have high end, and I think some of the other members of OPEC, what they usually do is they usually cheat. They'll negotiate a cutback, and then they won't do it. And usually just the mentioning of a cutback will prop the prices up, and they flood the market with supply to capture those higher prices, and then driving the prices down even further. Okay, any other views on oil? Okay, where's gold today? Any movements in gold?
It's down 0.4%.
Yeah, where's it hovering? Hasn't it been in a trading range for quite some time? Around what?
It's at 1,224.
Yeah, so it's been around 1,200 for quite some time, so there's been no real major movement. So is it up or down for the week? Do we know?
Up.
It's up for the week? So what would drive gold prices up for the week? Can you give me like a couple factors? There's really two, right? Fear and inflation, right? Fear and inflation. So after the terrorist attacks, what would you do? You'd probably buy gold, right? So has gold prices been affected over the last 24 hours by the terrorist attack? Is gold up for the day or the last 24 hours?
Yeah, there's a little spike this morning.
Yep, you got it, okay. And then what about inflation expectations? I mean, where's the 10-year treasury yield? Is the 10-year treasury yield a good proxy for movements in inflation expectations? As we know, the Fisher equation, the number one factor that really drives interest rates in the short run are inflation expectations. So where's the 10-year treasury yield?
2.43.
2.43, and has it been drifting down or drifting up, or
It's kind of been hovering around the same.
hovering around the same? Okay. If it was drifting down, then that means inflation expectations are going down and gold prices should have gone down. But if there's major fear because of the terrorist attacks, people are going to go into gold, and the deflationary aspect on gold prices will be offset by the fear factor. Okay, so you have to, when you're trying to forecast these asset classes, you want to think about offsetting influences and which ones are impacting the prices more. Not only in secular terms or cyclical terms, but also in short-term technical terms. Okay? And then where's the dollar to the pound and the dollar to the euro? And there should have been a movement in the dollar to the pound because of the terrorist attacks.
1.25.
1.25, and where was it like 2 days ago? So it's at 1.25 today. And where was it 2 days ago? Was it higher or lower?
I think it was higher.
So it was higher?
Oh, never mind. It was not.
So it was lower? That makes sense, right? Okay, so again, you would assume if there was a terrorist attack in London, what would you think would happen to the pound? If there was a terrorist attack in London, would the pound appreciate or depreciate in value? Would it appreciate or depreciate? Well, if you think that terrorist attacks are going to occur more often in London, are you going to invest in the UK with higher rates of terrorist attacks? No. So you're probably going to do what? Are you going to buy or sell the pound? You're probably going to sell the pound, and what's that going to do to the pound? It's going to cause it to appreciate or depreciate? To depreciate. Okay. And then if you're selling pounds, you're probably buying what? If you're selling pounds, what are you probably buying? Euros are? Or? Dollars. So it's probably going to cause the dollar to appreciate. So again, this is how the traders think about all this. Okay. So again, start practicing, monitoring the markets, come in with some ideas on what's driving the markets, and then I'm going to ask you later where you think the market's going to go. And then the thing is, if you can forecast where the markets are going, you can apply the derivative trades and either hedge off market risk or you can profit from the trades. Okay? All right, so let's go through the chapter, and if I have time, I'll go through some of the quiz really quickly too. So chapter 11 really gets at cash flows, free cash flows, in the capital budgeting process. So the first thing is you want to look at incremental cash flows. And I'll go through the income statement in a minute. We'll go through rules of incremental cash flow calculations. We're going to use nominal cash flows. Very rarely do you use real cash flows, where you have to discount the nominal cash flows to get the real cash flow and then discount it back at the real discount rate. That's too many steps. So we don't use that. We use nominal cash flows, and we use nominal discount rates. We'll look a little bit at variable and fixed costs, because you want to be able to take those into consideration. You would take into consideration variable costs, but you would not take into consideration fixed costs or fixed cost allocations as a negation into the cash flows, because those are considered sunk, and they distort the cash flows. What we're trying to do is to get to free cash flows that do not have distortions in it. And actually the book makes a recommendation of free cash flow calculations. I like to use EBITDA, as a pure cash flow, because you add back depreciation and amortization. The book makes some other modifications. As you make more adjustments to the cash flows, it adds in more distortions. And sometimes you just want to use pure cash flows, okay, to do the valuations or do the capital budgeting decisions. A little operating expense forecasting. Obviously, there's going to be a correlation between the amount of sales, so variable revenue, variable costs, but there's always got to be some kind of profit margin, some difference between marginal revenue and marginal cost. This is going to give you a profit margin. We're going to look at equivalent annual cost as a decision-making tool. We can use that for different assets with different lives. We can adjust the lives or normalize for the different lives. And we can also use the equivalent annual cost methodology for if we're looking to replace another asset, and the asset that we're looking at is the new one, and we're looking at the old one and the remaining life on the old one. So it'll normalize the lives, so it becomes really a powerful tool to make investment decisions based on different lifed assets. And then we'll talk about replacement decisions. How do you come up with opportunity costs, and really what's really important, which I don't think a lot of companies do a lot of, but they do it, is really exit strategies. When do you make exit decisions? When do you make a decision to discontinue the operations, to replace the equipment, to take the company public, to sell off the operations to a private equity firm? How do you make these investment exit decisions. And you'll be going through, when you get out there, you'll be going through hold sell decisions, constantly evaluating your operations and your products to be able to make a decision. Well, do we continue to carry this product or this division, or do we revamp it and run the investment analysis again? How much is it going to cost to restructure the division? Again, we're constantly using the discounted cash flow and the investment decision-making tools. But usually you'll, on an annual basis, go through a hold sell review of the product line, of the division, of the company, and see if we should still hold it, or do we get rid of it, or do we reposition it, or revamp it. When calculating projected cash flows, again, or profit, and again, when you're doing the discounted cash flow analysis, you could be using free cash flows, net operating income, EBITDA. You could be using, different methodologies, different cash flows, but the model is all the same. It's just, what are you trying to evaluate? You have to look at average selling prices per unit. Again, marginal revenue, marginal cost, and the profit. Fixed costs, which are called sunk costs, and you do not include overhead allocations. You don't include the overhead component, because that we consider that fixed cost allocations, and it distorts the cash flows. And then you also have to have an adequate return in the difference between marginal revenue and marginal cost. Capital budgeting, the goal is to estimate the net present value or the internal rate of return, but it's really net present value at the end of the day. You have to be able to calculate the incremental cash flows. The amount of unrestricted cash flows or free cash flow is the key. So you'll hear that a lot in terminology, is free cash flow. Free cash flow multiples. What is the free cash flow over the next 5 years that we're going to generate from the project or the product or the process? Free cash flows are the cash that can be distributed to creditors and the shareholders. So this whole process is for wealth maximization and stockholder share price maximization. Free cash flow is the project into the company. You want to look at the incremental differences in the free cash flow. Free cash flow with the project minus free cash flow without the project. How much is it contributing, to the value of the company, to the cash flow of the company? Project-related expenditures. You're going to look at working capital and inventory and accounts receivable. Long-term assets are your plant, equipment, and licenses. And then the real free cash flow calculation, which is going to be from the income statement. So you're going to create cash flow statements, projecting out the cash flows. Usually the time period is going to be 3 years, or 5 years, or 10 years, depending on where you go work. They're going to have certain methodologies. They're going to have certain time periods, standards, or even different types of projects and different types of acquisitions may have different holding periods. For a turnaround company, we're going to do a 3-year pro forma, a 3-year cash flow forecast, because we're going to go in, we're going to buy it, we're going to reposition it, and we're going to sell it off at the end of 3 years. If I'm buying a piece of real estate, I want to go in and reposition the asset. And if I'm a value add or an opportunistic investor, I'm going to go in, I'm going to buy it, I'm going to reposition it, probably take a couple years, stabilize it in year 3 or 4, and then sell it in year 5. And then large institutional investors that have a longer time horizon usually use a 10-year holding period or a 10-year pro forma. So it depends on who you are and where you work and what kind of assets you're looking to acquire will determine the holding period and the type of pro forma you're going to come up with. So free cash flow is going to be the revenue minus the operating expenses minus depreciation, amortization, and then you're going to take out the tax component. You're going to adjust for tax. Then you're going to add back the depreciation and amortization because that's just an accounting charge. Then you're going to take out the capital expenditures and you're gonna take out additions to working capital. So this would be, if we were to do free cash flows on a company we're looking to buy, this would be the free cash flow calculation that we would use for the company. And it has to be an established company too. So again, revenue minus cash expenditure and operating expenses, EBITDA, and again, you could end it right there and do the cash flow statements just using minus the depreciation amortization, then you have EBIT, which is operating profit, times the one minus the tax rate. And again, we'll talk a little bit about tax rates. It's a progressive tax system. So as your revenue moves up, you pay higher taxes, but you only pay taxes on the revenue by each tax category. So your marginal tax rate could be higher than your effective tax rate, and in most cases it is. If you take into consideration credits and other types of deductions, your real taxable or effective taxable income could be significantly less than the marginal tax. And we'll see what happens in Congress over the next year or two when they start renegotiating personal and corporate income taxes. That's going to be, when they're done with healthcare, they'll get to taxation. They probably should have done taxes first. Then you have NOPAT, which is net operating profit after tax. Add back depreciation and amortization. Then you got cash flow from operations, minus CapEx, minus the additions to working capital, and you get the free cash flow. So this will be set up, and then you will project out over the next 3, 5, or 10 years. You'll get your free cash flows. You know what the acquisition price is of the firm. Discount back the free cash flows. Subtract out the acquisition cost, and you'll get the net present value. It's negative, you need a price reduction. It's positive, you accept it. It's negative, you might have to go back and rework the pro forma, the cash flows, because you might have made mistakes. And again, if you still get negative present values, you might have to use a real call option valuation. And we'll talk about that last third iteration, which is the last piece in the investment decision-making process. And it's the last chance you have to get the project approved. And we'll talk about that. And this is just an example. So I would just set up, the inputs, the revenues, the operating expenses, the depreciation, the marginal tax, the CapEx, or the additions to working capital, and then just, subtract out, add back, and then take out the CapEx and the additions to working capital to get the free cash flow. And do that for every year within the holding period. Usually when you're valuing these cash flows for companies, there's going to be some terminal value or some residual value that needs to be added back to the last year in the holding period to calculate the net present value. So I'll go through an example. I don't know if I have enough copies of this. This is an exam that I used in another class, and if I can get these back, that would be great, but these are also posted online, but I'd like to use these for the other class. You might want to share them. But in the back of the exam's going to have a lot of the same stuff on it, because it lets you learn the stuff like, unorthodox monetary policy and yield curves, modern portfolio theory, the intrinsic valuations. These are all core concepts you want to take away. Then at the end of the exam are the real life problems. Okay? So I designed an investment banking problem where basically we buy a technology company. I also have a real estate investment banking example where we buy and build a multi-billion-dollar tech facility in Mission Bay in San Francisco. I also have a stock valuation example where we're trying to value Intel or IBM stock. And then I'll build on that. The final example probably just before questions. Okay, it'll be all focused on application. Okay, because that's the key takeaway. So calculating free cash flow, you want to compute the project's incremental cash flows or cash flows from operation, cash flows remaining after operating expenses and taxes paid, subtract the expenditures for project for CapEx, take out additions to working capital, and get a free cash flow after tax. You could even do free cash flows before tax. Some people want to take out that tax adjustment, because again, it's distorted. But you can do it, you can also do it after tax. You can also do discounted cash flow analysis, internal rates of return and net present values. You can also do that after the debt service, taking out the debt, so you're getting the real cash flows without the debt, after paying off the debt, so you can do that too. The concept is these are standalone projects. They're not related to each other, but you need to take into consideration additions. If you have two divisions and you're going to do a project, and this division is going to benefit by X amount of money by doing this project, those benefits need to be included in the cash flows of the project that you're analyzing. Okay? So you're going to have to work with the marketing people to be able to figure out cross-selling and complementary products that are going to generate complementary revenues due to the introduction of that division or that product or whatever, or buying that new company. Incremental net operating profits after tax, called NOPAT. And then again, you're going to add back depreciation and amortization. Depreciation and amortization, you have to add back because it's distorted. Okay, it's not a cash outlay, it's just an accounting shield to shield you against taxes to reduce your taxable income. Okay? It's deducted from the income, again, to be able to reduce your taxable income. Accounting earnings as opposed to free cash flow. You don't want to use the accounting earnings because again, they get distorted, either through write-offs or depletion, depreciation, amortization. Again, all of those are going to distort the cash flows. And you're trying to get the free cash flows to pure cash flows when you're doing these investment decisions, these capital budgets. So you're going to estimate the cash flows only, no overhead costs, no fixed cost allocations, only project benefits, only project costs. And then you want to look at how they affect the cash flows, and then do the discounted cash flow analysis. Opportunity costs, you have to take into consideration too. So if you do the project, you may be sacrificing another project that you could be doing. So it's eating into, there's some opportunity costs associated with doing this project over that project. So you have to take those costs into consideration when you're netting out the cash flows. And again, fixed costs, you have to ignore some costs that are already committed, and they don't affect the individual project. Those are firm-wide allocations, not project allocations. After-tax cash flows, you have to take out the taxes. Again, you may have tax credits or tax rebates, depending on what kind of industry you're in. So you may need to add back some of those credits and some of those allocations. If you're doing solar projects or alternative renewable energy projects, wind, geothermal, biogas, solar, the credits are huge. And those need to be modeled in your pro forma because the government gives you lump sum upfront credits, cash payments. So the cost of the development is significantly less once the government provides you with those upfront tax credits. Or you can take the credits over a time period, over the pro forma period. Again, that's just going to juice the internal rate of return and increase the NPV. So you got to take this into consideration too. So putting these pro formas together could be pretty simplistic, but again, these companies spend a lot of time putting together these pro formas and taking everything into consideration to get to the cash flows, to be able to then do the analysis. We're going to be using nominal cash flows. Okay, so nominal cash flows are not being adjusted for purchasing power. And actually, nominal cash flows and the nominal discount rate, the nominal discount rate, is already taking into consideration inflation expectations. Because as we build that discount rate or that expected return, we start with the risk-free rate. And what's in the risk-free rate? How do you calculate the risk-free rate? Test question. How do you calculate the risk-free rate? What is the risk-free rate? Test question. This is like one of the most important questions to walk away with, along with, understanding the weighted average cost of capital and the capital asset pricing model. What is the risk-free rate? Is the risk-free rate also a nominal interest rate? Is it a yield to maturity on a treasury security? Is the risk-free rate the yield to maturity on a treasury security? Yes or no? So you have basically a 50% probability of getting the answer right if you say something. You get a 100% probability of getting it wrong if you say nothing. Okay. So is the treasury yields, would that be considered a risk-free rate? U.S. Treasury securities, would that be considered the risk-free rates? Yes, it would be. Yes. 10-year Treasury, is that a risk-free rate? Yes. Is the 5-year Treasury yield a risk-free rate? Yes. So how do you calculate the interest rate on a 10-year Treasury? It's on your exam. You read it like 4 times on the exam. What equation do you use to come up with the risk-free rate or nominal interest rates on the 10-year Treasury? How do you come up with nominal interest rates? What equation do you use? You probably need to tattoo the equation on your arm so you never forget it. The Fisher equation. Okay, so what's the Fisher equation? Okay, but give it to me in English. Exactly. The real rate plus inflation expectations. So if I'm building a discount rate, or building expected returns, and I start with the risk-free rate, is there inflation expectations embedded in it? Yes or no? Yes, it is. So basically nominal discount rates, nominal interest rates, nominal expected returns already have factored in the inflation expectations. So we don't have to discount the cash flows by an inflation rate. It's already embedded in the discount rate. You may want to write that down in your notes. You need to memorize that. Okay. Oh, look, I already wrote the answer up on the board. It was already there for you. So it already takes into consideration the expected return and the cost of capital. I mean, we're going to derive the cost of capital. We're going to come up with the cost of debt and the cost of equity. In the calculations for the cost of debt and the cost of equity, is the risk-free rate in there? Yes or no? When you're determining the cost of debt and equity, is the risk-free rate in the equations for the cost of debt and equity? Yes or no? Yes, it is. Okay. So you're already including inflation expectations in the building of your cost of debt and equity and your weighted average cost of equity. So it's already in there. Okay. So please remember that the Fisher equation is the determination of the risk-free rate. The yield curve, interest rates along the yield curve, are all risk-free rates. And all risk-free rates are the base rates in building expected returns and cost of capital, both for debt and equity, and the weighted average cost of capital for the firm. Because it's really important, because the weighted average cost of capital for the firm is the discount rate that you use to discount the cash flows when you're making investment decisions. So it all builds on each other. Okay? And if you're missing little pieces, you need to fill in these gaps. And then the book uses this nomenclature to come up with the cost of capital, where this is the real rate and this is the expected inflation rate. Their approach, my approach is, mine's a little bit more simpler, but this is a more accurate calculation of the cost of capital using the Fisher equation. This is a little little simpler. This is a little bit more accurate of the risk-free rate. So nominal cash flows, again, we have a $50,000 investment. Free cash flows over 4 years are going to be $20,000 each. We have a 15% cost of capital. It's going to cost us 50 grand. The cash flows are 20,000 over 4 years. There's no terminal value here, so obviously there's no salvage value or resale value to this investment, which is probably incorrect. But this is just a simple example. And then you just discount the nominal cash flows back to the present to get the net present value. And in this case, it's $7,099, $7,100. What we could have done was take these cash flows and divide it by a 5% inflation rate. So we divide it by 1.05. And then what we could do too is we could figure out the real cost of capital, which is, in this case, it was the 15% was the nominal rate, 1.15 divided by 1.05. So I'm adjusting the nominal rate by the inflation rate, and I get 9.52%. So I can take adjust the nominal cash flows to create real cash flows, then I divide it by the real discount rate to get the net present value, and in both situations, the net present value is the same. So my question is, other than for academic purposes, I have never seen anybody use real cash flow calculations. It's too complex. It's too many steps. Why would you use 2 more steps when you could just use 1? You've added 2 more steps to the process. That's inefficient. So what you'll see in most cases is they're using nominal cash flows. I don't know that they use real. I've never seen it in my career. And then corporate taxes. Corporate taxes are marginal taxes. It's a progressive tax system. The more you make, the higher the marginal tax rate, but at some point it caps out. So, and then it turns into a flat tax, basically. So the maximum individual tax rate is 39.6% as of today. We'll see how it's going to be at the end of this year or next year. The corporate tax maximum is 35%. So again, what's interesting is there's different depreciation approaches for the reporting of the financials and the cash flow statements and for the tax reporting. We use straight line depreciation to lower the taxable income under GAAP accounting standards. And then we use modified accelerated cost recovery systems, an accelerated depreciation system for taxes. So that's why you want to run the project or run the cash flows pre and post taxes. Because under the accelerated tax system, depreciation, you're able to write off that asset in a shorter period of time. So the tax shield, the savings on the taxes, are significant in the early periods of the pro forma. And those early year cash flows are the most valuable when calculating the present values and the net present values and internal rates of return. So you want to run it both ways, pre-tax and after-tax, and see what your after-tax internal rate of return is. So you want to do it both ways. And then your terminal year free cash flows, again, you have to take out additions to working capital. And additions to working capital are changes in cash equivalents, changes in accounts receivable, changes in inventory, and changes in accounts payable. And again, you can look at the cash flow statements in your book to get a look at that. Again, there's a lot of distortions in here, and there's a lot of distortions in the CapEx over there. In a lot of cases, I wouldn't use it. I'd use EBIT out, or EBIT. Because again, these are just gonna distort, but you'll probably wanna run with the adjustments and without the adjustments to make your decision. So when you're doing the pro forma and building those cash flow projections and cash flow statements to get to the net present value, you're gonna have to forecast. So you're gonna have to forecast all the expenses and all the revenues. Okay, and you're gonna have to spend some time doing the projections, okay? The cash flows in the early periods have a significant impact on the outcomes. So you really need to do a good job if you're forecasting marketing, revenue generation over a 3-year marketing period, or advertising campaigns, or you're buying a company, or buying an equipment, or buying a piece of real estate. You gotta nail the first 3-year cash flow projections, at least. And then it gets really hard to project out past 5 years. And usually it reverts to some average. And we'll do an example of that. You also want to remember that the terminal value, we'll talk about that more. You know, what is the residual value? Imagine this is a business. Well, I'm gonna get cash flows over the life of the business, but I'll probably be able to sell the business at the end of the 4 years. That value needs to be taken into consideration here. It's not in this example, but it should be. But the terminal value calculation is also significant in contributing to the present value, net present values, and internal rates of return. And you may want to write these notes down. You should be writing these notes down because these are all the secrets. Okay, this is the stuff that's not going to be nuanced or obvious by reading the book. These are based off 30 years of experience. So what I've seen in the past is that underwriters, people in the corporate finance departments, what they'll do is to get these net present values out because they really want to do this project because they get compensated on this. So they get compensated, you get compensated by doing marketing programs and advertising campaigns and building real estate assets and buying companies. You get compensated for that if you work for the company. So how do you get the company to approve your project? Well, what you do is you juice the terminal value. What they try to do is they try to be aggressive in growing the cash flows in the pro forma period to get the present values and the net present values up, to get the projects approved. If your cash flows aren't growing fast enough and your terminal value is too low, your net present value is negative, they reject the project, you don't get your bonus. So the incentive by people internal in the firm is to basically make projects look better than they are. Okay, that's an incentive, all right? And you'll probably be put in that position. So that's the incentive. So I can increase the present value, net present value, and internal rate of return by growing the cash flows up very quickly in the early years. I can lower the expenses in the early years to increase the cash flows, to get the net present value, and internal rate of return. And what they try to do, which I've seen, is they will increase the terminal value because the investment committee and the board only looks at the first 3 to 5 years. They don't look at the last year in the holding period. And what the underwriter's done is they've juiced the terminal value on the end to juice the present value, net present value, and internal rate of return. To get the net present value positive and get the internal rate of return greater than the hurdle rate. So you will probably be put in that position. And you get bonuses. If you get the projects approved, you get bonuses. If you don't get projects approved, they will not pay you for rejected projects. Right? They only pay you for successful projects. And usually what they'll do is they'll approve the projects, the company or the investments. They'll monitor them, but some of these acquisitions, it takes years to be able to see the benefits associated with the acquisition. And in some cases, the individuals are gone by that time. They spent their 3 years, they brought in all of these projects, they got their salary and their bonuses, and then when some of the projects that they approved started to go south, because they were fudging the numbers, they leave. They leave the company. And you will witness that. Because it happens in all companies. Okay. So you need to forecast the incremental cash flows to be able to get to the net present value. The net revenue, the operating expenses, depreciation, amortization. You may be put into a position where you have 2 projects you're evaluating. One's a 3-year, one's a 5-year holding period. One's a piece of equipment that has 3 years left. One's a new piece of equipment that has 5 years life. So you use the equivalent annual cost method to be able to adjust for the different lives. And this becomes extremely powerful equation. So what you do is you take the cost of capital, 1 plus the cost of capital to the holding period, divided by 1 plus the cost of capital to the holding period, minus 1. And then you multiply that by the net present value times the opportunity cost of capital, you're going to get the equivalent annual cost. So in this case, you have 1.01 to the second, 1.01 to the second minus 1 times the 250 million times the 10%. It's going to give you negative 1.4405. In this case, you have 10% cost of capital. The project's going to cost 360 million. 1.01 to the third, 1.01 to the third minus 1. And then you divide it, multiply it, and this is going to give you the equivalent annual cost. In this case, the net present value is less than this one, so you're going to do this project over this project. If this was positive, this was negative, you do that one over this one. If this net present value is less than this one, you accept this one and you reject it. So remember, so the only difference in these two is you subtract out that 1 and then divide it. Okay? And then exiting. How do you make exit decisions? How do you harvest the asset? How do you replace the asset? How do you make a decision to spin off the company, to discontinue the company, to replace the equipment, to spin off the company as an initial public offering, to sell the company as a private equity firm? You have to make those decisions. So usually, what you want to do is you want to run a net present value rolling over the pro forma period. And the net present value is going to rise in the early periods, and then it's going to start to degrade. So there, you want to calculate the percentage change in the net present value over the life of the asset. Okay? Once the percentage change in the net present value equals the cost of capital, the discount rate, that's the point in which you sell it. That's the point in which you sell it. So the percentage change in the net present value, once it reaches the cost of capital, the discount rate, that's when you sell it. Well, firms are smarter than that. What they're doing is they're looking at the percentage change in the net present values, projecting them out, and anticipating that they're going to need to sell the asset a year or two before that period. That's what brilliant investors do. The private equity firms do this. Brilliant investors like Warren Buffett and Sam Zell on the real estate and the equity side are projecting these things out and knowing that they're going to need to sell off the asset within a year or two before the net present value growth rates approach the capital costs. So they're always looking forward to figure out not only when to buy an asset, but also when to sell it. And this is where companies make their mistakes, and this is where they become really successful. They know when to get out. They know when to sell. And these decisions should be rules-based. There should be a criteria that needs to be met to be able to make those exit decisions. A lot of firms do not do that. They basically rely on a bunch of guys on an investment committee that are in their 60s and 70s years old. They have experience, and they basically say, now I think it's time to sell. Based on gut feel, not based on rules or analysis or science. It's gut feel. And they make mistakes. And if they make mistakes consistently over time, they're going to get fired. If they make good acquisition decisions that compensate for their mistakes, they'll still be employed because the win on the projects totally compensates for the losses on making bad exit decisions. So this is a whole other area that really needs to be focused on. Okay. So how much time do I have?
40 minutes.
Okay, I think I might be able to do this in 40 minutes. Break out your calculators. And you're gonna need to help me. This is usually how it works. We're gonna be in a meeting. You're all gonna be in a meeting. You all will have done your research. You all will have been on the investment banking committee or corporate finance or the acquisition, or they're pulling you in because they're looking at buying a company. We're thinking about buying a company, we're thinking about merging with a company. We want to get your input, on the acquisition and merger process. I like to bring everybody in, and I like to hear, dialogue in regards to the deal, so I can get complete, not yes people, groupthink, and looking at constructive criticism, feedback, because you can't make mistakes in a lot of these situations. We're talking about multi-millions and probably billions of dollars. So to make a mistake is really detrimental to the firm. So we need feedback. And then what we need also is not only participation, but participation in the calculations. Okay. So as you're doing the calculations, everybody should be practicing the calculations and then verifying the outputs, verifying the numbers. So I'm not making mistakes. Okay. Because I remember probably like 10 years ago, I was in a class. We were running through a real estate investment decision, and the students gave me the wrong numbers in the discounted cash flow calculations. They gave me the wrong numbers. And nobody in the class said anything to me. They let me go ahead and calculate the whole thing, spent like an hour doing it, and then somebody spoke up and said, oh, you made a mistake on some of your calculations. And it's like, well, we already went through and we verified all that stuff. And some people said, no, they gave you the wrong numbers. Can you imagine if you were in a meeting with an investment committee and nobody was saying anything, and your team allowed you to put the wrong numbers up, and you came up with the wrong, I would get fired for that. You'd probably keep your job, but I would definitely get fired for that. They're putting up the wrong numbers and doing the wrong analysis. Okay? So it's really, really critical that you do the calculations and you do the verifications. Okay? So we're going to do the first one. This is a investment banking. We're going to buy a tech company. Okay? As we know, there are 4 main valuation methods. For this case study, we are going to use earnings before taxes, depreciation, amortization for the target company. There's the acquirer and the target company. This is M&A terminology. The following are the case study assumptions. We're going to use the perpetuity model, we're going to use Gordon growth, we're going to use the multiple approach, and we're going to use discounted cash flow. Okay? It's a large cap tech company in hardware, software, cloud, mobile, global products, and service sales. Okay? So it's a fairly established company. This is probably, we're going to buy it from a venture capitalist or a private equity firm. Okay? We could be Oracle or Cisco or whoever. The free cash flows currently are $200 million a year. Free cash flow growth rate, we estimated at 5%. And then when we calculate the terminal value, we're going to use 3%. Okay. The weighted average cost of capital, we can use that as a discount rate. And we're assuming the capital structure, we're financing our assets with 70% debt and 30% owner's equity. But actually, I already calculated the WACC. Okay. And the discount rate that we're going to use going in is 22%. And then the discount we're going to use on the terminal valuation is 24. I'm actually giving you the answers, okay, because of time. We're going to grow out the cash flows, 20% in year 1, 18 year 2, 15 year 3, 12 year 4, 6 in year 5, and then we have to grow it out 1 more year to get the terminal value, so we use 3%. The company is offering the target company will sell the company to us for $4 billion. And for our purposes, our holding period is 5 years. We use a 5-year holding period. Okay? This is a pretty risky investment. Right? Technology companies are pretty risky. So then we're going to do the valuations and try to make a decision here. So start giving me some numbers. So So for the perpetuity model, what do we use for the cash flow? I got 2, 4, 6, 8, 10, 12, 14, 16, 18, 20, 22. I got 23 analysts in this room. So what do we use for the first year cash flow for the perpetuity model? And try to give me the answers as fast as possible, because I only have 30 minutes. So give me the first year cap, it's right there in the assumptions. You can give me a wrong answer, but I'll correct it for you, but if you don't say anything, I can't correct it. We're just wasting time.
Cash flow over expected return.
Yeah, we know that, but give me the cash flow for the first year that we're gonna use to start the valuation process.
200 million.
What is it?
300 million.
That's 200, that's this year. When we do valuations, do we use this year or next year's? We use next year, so what, how do we get to next year's cash flow projection? What is it? We use the growth rate. So what is the, so we got the 200 million. Okay, what's the first year growth rate? What is it?
5%.
Is it? That doesn't make sense, I wouldn't buy this deal. What is it? 20%, okay? So what's the cash flow in the first year? 240,000, okay, excellent, so we got it. All right, 240 million. Okay, what's the, our expected return or discount rate that we're gonna use to discount the cash flow using the perpetuity model? I already gave it to you, they're all right there, it's just, do you know how to do the calculation? What's our expected return? What's our WACC? What's our discount rate? What are we using to make investment decisions? It's right there.
22%.
Thank you. Well, what's 240 million divided by 0.22? 1,090, and just round it. 1,090? Yeah, no decimal. 1,091. Got it? Okay, so that's a million. Got it. First one done. Okay, now what do we do? How do we do the Gordon growth? Okay, so how do I adjust it? What's the G? What G do we use? I gave it to you.
T plus 1.
Nope. What's the G?
G plus 2.
What growth rate do we use?
20%.
What is it?
20%.
No, that's the growth rate in the cash flows. That's not the constant growth rate.
5%.
5%. Yep, 5%. So negative 0.05. What does that give us? Give me the mathematicians. What does it give us? 0.17. What's $240 million divided by 0.17? 1,411. 12? Got it. Okay, got that one down. Now let's do the multiple approach. Do we know what the cash flow is for next year? What's the cash flow for next year? What's the projected, I'm testing you again to see if you're following along. What's the projected cash flow for next year? Exactly, I'm just testing to see if everybody's like following. I can't have one person following, the whole thing. So it's what? Okay, 240 million. And then what do we do? Multiply that by some multiple. It's gonna give us the value. Okay. Is there anything in here that's giving us some multiple ideas? Doesn't it say up at the top, multiple approach, calculate the multiple using a 12% expected return? So how do I manufacture a multiple out of a 12% expected return? I'm testing you on your exam. You got it. So 1 divided by 0.12, what does that give me? What's the multiple?
8.333.
So 8, let's just use 8.5 times. So what's 8.5 times 240 million?
2,000.
What is it?
2,000.
2,000. So 2 billion. Got it. Isn't that, it's not that hard, right? Okay, let's manufacture some more multiples, okay? Can I use the going in whack to calculate a multiple? Can I use the going in? This might be given to me by the investment banker. Can't I use 1 divided by 0.22? Yeah. And what does that give me?
4.5.
So 5. And what's 5 times 240?
1,091.
1,091. Is that the same as this? It's the same. Okay. Key is that we think in multiple terms. In multiple terms. Okay. Perpetuity is not used. It's used when you convert it to a multiple. Because the multiple and the discounted cash flow methodology are the two most popular in investment banking and underwriting. Can I use the Gordon growth down here?
Yes.
And then what would be 1 divided by 0.17? And what's the multiple on that? You should all be doing the calculations. You should have a calculator and doing the calculations.
6.
What is it? 5.9. So what's 5.9 times the 240? We should get basically the Gordon growth.
1,412.
Yep, 1,400. So what I'm just trying to do there on this little exercise is to show you that it's the same. Okay? This is how everybody thinks about it. They don't do it this way. I do it this way because I'm teaching you how to do it. Okay? So we have the 3. Now what do we do now? Now what do we do? Now what do we do? Now what?
Discounted cash flow.
Exactly. Now we do the DCF. Okay? So what's the, and what are we trying to calculate here?
Present
The
value.
terminal, the present value. Excellent. Excellent, excellent. So what's the first thing I do? What's the holding period? 5 years. Okay. And then what's the discount rate? What are we going to use to discount the cash flows? What is it? 1.22, 1, 1.22, 2. You guys may want to start calculating these. Start giving me the discount factors. What's 1.22 to the 3, 1.22 to the 4, and 1.22 to the 5. This is 1.22. This is what, 1.4?
1.488.
Yeah, 1.49.
Yeah.
Okay, and then what's this one?
1.816.
1.82. Yeah, round up on the decimals. And then 1.22 to the 4.
2.215 or 2.22.
Yeah, 2.22. And then what is 1.22 to the 5th?
2.7.
2.7. Okay, actually, now we got the discount factors. So what cash flow do we use for the first period? What is it?
The 240.
240. Got it. 240 million. Okay, and then now how do we get the second year? What? How do we get the second year cash flow?
You multiply the 240 by the next year's.
Yep. And what is it?
18%. Yep.
1.18. So it's 240 times 1.08. What is it? Hurry, hurry, hurry.
283.2.
283. Yeah, let's just round up. Okay. And then what do I do?
Next year,
What is it?
15%.
1.15. So what's 1.15 times 283?
276.
276. And then what?
12%.
And 12. 1.12. So it's 276 times 1.12.
269.
269. And then how do I get the next one?
6%.
What is it?
6%.
4.06. So it's 269 times 1.06.
254.
254, okay? And then what do we do to get the terminal value? Is that right? What is it?
I say I was not getting.
I have a different number for 283 times 1.15.
Okay, so 283 times 1.15 gives you what?
I got 326.
Okay, can somebody verify that?
I got
Okay, so what did you get?
326.
Okay, I need verification now that we made some there.
Yes, 326.
Yeah, rounding it
Well,
up.
Yeah, just round it up. Okay, and then 326 times 1.12,
365.
Yeah.
365, and then 365 times 1.06,
I just did
387.
387, thank you. And then don't we need to round that out when we're here to get the terminal value? And then when we multiply that by 1.03, and give me that was 387 times 1.03,
398.56. 389.
399. Okay, got it. We need to get the terminal value. All right. And then, are we gonna assume that the cash flows are gonna remain flat or grow at a constant rate into perpetuity? This is a tech company.
grow.
What?
They're gonna grow, right?
They're gonna grow, okay. Are we gonna use the going-in discount rate or a terminal discount rate? Is it more risky in 5 years from now than it is today? So don't we wanna add a couple hundred basis points on top of the going-in discount rate to factor in additional, unforeseen risks in the future? So what's our terminal discount rate?
24%.
What is it?
24%.
24, and then what's our terminal growth rate? Are our growth rates, our terminal growth rates, using Morton growth to get the terminal value, are they gonna be higher or lower than the growth rates here? They're gonna be lower, significantly lower, okay? So what did we assume? What is it? 0.03?
Yeah.
So this gives us what, 0.21? So what's 399 million divided by 0.21?
1900.
Is that right?
Yeah.
So 399 divided by 0.21.
Yep.
So it's 1,900,000,000? Okay. So that's gonna be our terminal value. Okay. And then what do we do with the terminal value?
Add that to the present.
You got it. So add it to the last year's cash flow, and what do we get? So what's the total cash flows that we're gonna receive in last year of the holding period? What is it?
2287.
Okay, can I have verification on that?
Yep.
Got it? Excellent. So what's 2287 divided by 2.7? Now we're gonna get the cash flows. Let's count the cash flows. So what's 2287 divided by 2.7?
847.
847.
Yep.
And then what's 365 divided by 2.22?
164.
164. And then what is 326 divided by 1.82?
179.
179. And then what is 283 divided by 1.49? 190. And then what is 240 divided by 1.22?
197.
197. And then what's 197 plus 190 plus 179 plus 164 plus 847?
1,577.
1,577. Is that right?
Yep.
So basically it's 1.6 billion. Is that right? And then what are they asking? And what's the net present value? What's the net present value? What is it? Positive or negative? Negative how much? Okay, under this scenario, based on the assumptions that you put together, would we accept or reject this project? Would we buy this company? Rejected. Okay, but I want to buy the company. We want the company. Okay, we want this company. So what's the first thing we can do? What? We can go back and renegotiate the price. Okay, and what do we renegotiate the price to? How much in price reduction do we ask for? We go back to the selling company and we ask for a price reduction. In what amount?
Wouldn't you want it to make the NPV zeros?
Exactly. So what would be the price reduction, the amount in price reduction we would ask for?
2.4 billion.
He got it. So our price reduction would be the negative net present value. That's the first step. That's your first iteration. But I'm sorry to say that they said no. We want 4 billion. So, but we really want the project. What can we do? What can we do now? What can we do? Can we go back and review our assumptions? Can we go back and review our assumptions? Okay. What assumptions would we go back and look at? We go back through the underwriting process. What assumptions would we reevaluate? Aren't we trying to get the present value and the net present value and the internal rate of return up? Through this calculation, what could we do to pump the PV and the MPV and the IRR? Yeah, but how do I do it? Go through the assumptions. What assumptions do we make in coming up with the PV? Go back and audit the variables. And what variables do we look at that we can go back and look at that may increase the present value? What were the variables that we used in the assumption?
Could you change the percentages?
What?
Could you change the percentages for us?
In what? The percentage of what?
The denominators with growth rates.
Yeah. Could we go back and review the growth rates? Maybe we underestimated the growth in the cash flows during the holding period. So if I increase the growth rate, what's going to happen to the present value? If I increase the growth rate, the present value is going to go up. What's going to happen to the net present value?
Go up.
It's also going to go up. What's going to happen to the internal rate of return? It's also going to go up. Okay, so I could go back and look at the growth rates. What else could I look at? What other factors could we review? Go back through the underwriting process and identify the variables that we could go back and audit. What?
Would you want to change the I we use?
Yeah, maybe our expected returns are too high. And we'd have to go back, maybe we overestimated the expected return. Maybe we're willing to actually take a lower expected return, so maybe our discount rate is too high. So if we lower the discount rate, what happens to the present value? Goes up. What happens to the net present value? Goes up. What happens to the internal rate of return? Goes up. Okay, what other variables could we audit? How much time do I have? Okay. What other variables?
Multiple.
Uh,
The 12% expected return that we use.
Say that again?
The 12% expected return we use to find our multiple.
Yeah, if that's using the multiple approach, but that's true. Maybe we totally underestimated the multiples. I mean, what if the multiples are like 45? I mean, some of these tech companies have really high multiples. What's 240 times 45? Or even 35?
240 times 45 is 10,800.
That's too high, right? So it's 10 billion, so we're using too high a multiple.
And then 240 times 35 is 8,400.
8 billion. And then what about 25?
6,000.
6 billion? So just by playing with the multiples, you can start to approach the selling costs. So we can actually back into the multiple based on their offering price and our cash flows. So we're starting to reverse engineer the finance. Okay? So we could do that. But I want to use the discounted cash flow. So what other variables in here that we could go back and audit? Could we have underestimated the first year cash flow? Yeah. So the level of the first year, because everything's based off the first year, right? So it's really important that you nail the first year. Okay, so we got the growth rate and the cash flows, we got the discount rate, we got the level of the first year, there's a couple more. It's buried at the end. Do we calculate the terminal value? Do we calculate the terminal value? Yep. Do we grow out the cash flow from the last year to the 6th year? So maybe we underestimated this. Right? What else about the terminal value calculation? Where are we heading in this thing? What?
The discount?
Yeah.
Internal discount?
Maybe we overestimated the discount rate, right? So this is high, this is low, right? So it's gonna push the PV and PVR down. But if we lower this, then the terminal value goes up, the present value goes up, the net present value goes up, and the internal rate of return goes up. So maybe we overestimated the discount rate. What else in the terminal value calculation? There's one more variable that we added in there.
Terminal growth.
The terminal growth rate, maybe we underestimated that. Maybe the terminal growth rate into perpetuity is a lot faster than we assumed. Well, if we increase the terminal growth rate, then the terminal value goes up, the present value goes up, the net present value goes up, and the internal rate of return goes up. So you gotta go back and you gotta audit. Not only these basic assumptions, but the financial statement. Okay, and I'm not getting into the financials because I like to operate at this level, because this is, the fundamentals are really the key here, okay? Okay, so I got some bad news. We went back to the selling company, or actually I got it wrong. We ran the numbers, we audited all the variables, they're actually right. They're correct, okay? So again, I'm getting a negative MPV. I couldn't get the price reduction, we audited the variables, they're correct, I'm still getting a negative MPV of 2.4 billion. You got one more option, one more iteration, if you really want this project. How much time do I have?
15 minutes.
15, okay, I can do it. Luckily I practiced this last week, so it's quicker. There's one last piece, and this is like buried in chapter 20, okay, when it should be brought up front into the capital budgeting section of the class. You can calculate a real call option. Okay, it's called a real call option. So you calculate the value of a real call option. Now, this real call option valuation methodology was added to the investment decision-making process about 20, 30 years ago. And it's still not widely accepted, but it is accepted in biotech companies and other types of companies use this as a third iteration to their capital budgeting decision-making process. Okay? I'm not gonna get into the mathematics, but I'll just let you know that the model that you use is called the Black-Scholes model. And if you want to look it up, you can look it up. And the other is the binomial tree. And this will give you the value of the real call option. Okay? And the real call options are very similar to regular call options. Okay, where you pay a premium, and you know, if the value of the company increases significantly, you're going to be in the money, and you can calculate the value of this call option. What's different about the real options compared to the call options that you're studying is that they're long dated, because we're investing in a project for a long time. So one significant portion of the value of the call option is time value, because they're long dated. You can't buy these things. These are calculated valuations. The other is the volatility in the valuation. Is there volatility in tech company valuations? Are they stable? No, they're very volatile, right? So So all of a sudden, something could kick in, and your revenues shoot up, and the values explode in some of these companies. So you could get in the money. There's a high probability you're going to get in the money by buying this company. Okay? So volatility valuations. The other is management decisions and the ability to actually exercise the option. This adds a qualitative factor to the valuation, to the value of the call option. So these four factors add value to the call option. So the question becomes, what's the value of the option? What does the value of the option need to be for us to make this investment decision? So we know that we got a negative NPV of how much?
2.4.
2.4? 2.4 billion. So doesn't the value of the real call option gotta be at least 2.4 billion? And if it is, the value of the call option is 2.4 billion, then what is my net present value? Equals 0. Do we accept or reject it? Accept. And if the real call option value is less than the negative present value, then what's my net present value? It's going to be negative, and do I accept or reject it? Or reject it. And if the real call option is above the negative net present value, then what's my net present value? It's going to be positive. And do I accept or reject the project? Accept. That's it. So we went through this once. And we'll do it again. We'll do a real estate deal next time. Okay? And then we'll do a stock valuation. And then for like the final, I'll have another couple case studies so that you will practice, going through this process. And then the only thing we're really missing is really building those free cash flow statements. That's a whole nother process. All right? And then I'll look at your stuff and if you want to look at anything. And if you could put your surveys and feedback in the box on how I can improve the process, I appreciate the constructive criticism. Were we able to record this, or was like completely out of the? Yeah, we totally missed it. Yep. But I'll record it in the next class.